Hi, everyone. This is Jason Barrett of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. We're recording this interview on Monday, September 8th, 2025. The US dollar gold price is over $3,600. It's been on fire the last 5 or 6 months. There was a correction. A lot of people were predicting that the US dollar gold price would go back down to maybe 2,500. Instead, it's gone the opposite direction from what it seems. The yields on the 10-year, the yields on all the treasury bonds are down recently on the market starting to price in rate cuts. Today's special guest is a returning guest. He put out a book last year called How to Listen When Markets Speak. He's also the founder of the Bear Traps Report, which is one of the best paid newsletters on Wall Street. He has a lot of paying customers. And he used to work at Lehman Brothers. He actually ran their most profitable division before Lehman Brothers collapsed, and he wrote a best-selling book on that. Larry McDonald of the Bear Traps Report, thank you for joining me again.
Thanks, Jason. Appreciate it, bud.
So, Larry, I saw your interview earlier today on Fox Business with Charles Payne, and you were hinting at financial repression. I want to get your thoughts, though, on the Fed's rationale for the rate cuts because they've been holding off for so long. President Trump is calling Jerome Powell too late. Do you think that the jobs reports, the bad numbers on the jobs reports, is that the rationale the Fed needed, or do you think there's really another reason behind why the Fed would start to cut rates now?
Well, there's clearly something going on in terms of, ISM prices paid, Philly Fed prices paid, Richmond Fed prices paid, core CPI, super core CPI, all the inflation readings are going the other way. And gas prices are up nationally quite a bit the last 10 days. Oil's down, but it's actually bounced way off the April and May lows. So essentially, the Fed is cutting rates into an inflation that's, really bouncing. And we've never seen anything like this since the 80s, really. And so the probability that they're, cutting into kind of a stagflationary environment, in other words, they're worried that the economy's slowing down, because if the economy slows down, that $1.2 trillion of interest costs, if you go into a really big slowdown, then your tax receipts relative to your interest costs, that ratio shrinks. So right now, the tax receipts relative to interest costs are like 22%, which is, if you look around the developed world, like the major G10, G20 countries, we're like 3 to 4 to 5 times, more that those tax receipts relative to interest costs. That ratio is crazy high, near 25%, and no AAA or no investment grade, no high investment grade country has that situation. But the good news is the United States has a resilient economy. But the worry is that they're really cutting rates into a stagflationary slowdown, and where they haven't really killed inflation, and that's causing this massive historic migration of capital into hard assets, which we talk about in our book, How to Listen When Markets Speak.
Now, normally, Larry, if there was economic slowdown or recession, we're seeing this with artificial intelligence causing a lot of job losses, stagflation, these types of problems. There would be a lot of professional investors, institutional investors, or hedge fund managers that would go into longer duration U.S. Treasuries. Is this one of those types of scenarios you mentioned, stagflation, where we're not going to see a lot of professional managed money go into long duration U.S. Treasuries?
Well, one problem is globally, yields are up a lot. So in recent weeks, we've had the UK bond yields breaking out, we've had the French bond yields breaking out, Japan bond yields breaking out. So when the global bond yields are breaking out, it typically that a lot of times will drag U.S. yields up. The good news is for bond yields is that in the last week or so, that 30 years gone from close to 5% down to 4.7-ish. So bonds are rallying, which is weird because when the Fed cut rates last time around, they cut 100 basis points when they started kicking off the easing cycle within the last year and a half. When they cut rates, the long end sold off. In other words, bonds were lower in price, the yields were up, and it's I find it hard to believe that bonds are going to rally all that much if you get that weaker dollar, that really brings inflation back very fast because commodity prices really boom, can potentially boom with that weaker dollar, right? So your weaker dollar reaccelerates inflation that really hasn't been killed. Like if you think of like inflation, it's like a fire that you put some water on over and over again, but it's still simmering, and then that flame can just kind of reinvigorate and reignite, and that's what a weak dollar will do. A weak dollar, because you're easing policy from the central bank, that can very easily bring back inflation pretty fast.
And during the 1970s stagflation, to add to your points, inflation came in waves. So what Arthur Burns, before Paul Volcker came in, he was raising rates. He wasn't raising rates fast enough, and he thought he had tamed inflation, and then inflation started to come back. So it came in waves, multiple waves in the 1970s stagflation.
Right, and that's very important. And one of the lines in our book is inflation. It gets under the seat cushions. It gets under the carpets, right? You can't, once inflation gets up near that 6, 7, 8%, it's very difficult to kill it without at least 6, 7, 8% unemployment. Historically, that's the only thing that's killed that kind of inflation. So inflation's here to stay. Plus, don't forget, this whole reshoring agenda from the Trump administration, bringing jobs back home, they mean well, but it's very, very inflationary, right? And then wars, the Ukraine war, that's not the Trump team's fault, but that when you think of the rebuild of the Ukraine, think of the rebuild of Gaza, think of the all the copper and all the commodities you're going to take, and then you think of the U.S. power grid that's 50 years old, 30 years old in other places that really needs to be reconstructed. So wars are inflationary, reshoring jobs is inflationary, and really kind of rebuilding the power infrastructure of the United States to support artificial intelligence, that can be inflationary as well.
And to add to your points, it also looks like President Trump is moving the naval fleet into the Caribbean, into Venezuela. Now, I'm not in favor of regime change with their foreign policy because the U.S. government has blundered that, what in Iraq and Afghanistan wasted trillions of dollars. But unfortunately, Larry, it looks like there is potentially going to be a regime change in Venezuela. It looks like they're talking about going in after the narco terrorists and potential regime change.
Well, that would be interesting because if I mean over time that's going to lower oil prices because you're going to bring in if you bring in a market friendly government, market friendly new government there that would potentially bring back Exxon, Chevron, U.S. technology that could eventually bring a lot of oil out of that part of the world, but that'll take a while.
Yeah, and it's not going to be done efficiently too, as we've seen with Iraq and Afghanistan. I mean, they were what the oil companies in the U.S., what Exxon and Chevron were supposed to get access to the oil fields in Iraq, and that didn't happen.
Right. Yeah, exactly. I mean, there's so many narratives when it comes to wars and conflicts that never really materialize. You remember when the Ukraine was invaded by Russia, it was supposed to be really bullish for a lot of agricultural commodities, phosphates. It was supposed to be really bullish for uh, platinum and palladium, all these commodities that are controlled in that part of the world. And we actually ended up in a real nasty bear market for platinum, palladium, and phosphates as Russia, used the commodities to fund the war. So yeah, so you have to be very careful with war narratives. Oftentimes, the war narratives reverse around around the start of the war.
Now, you were just in Washington, D.C., meeting with the U.S. Treasury. Would you say, is it fair to say that President Trump and Scott Bessent, the Treasury Secretary, that they want a weaker dollar, that they want bond yields down substantially so they can refinance all that debt that you're talking about that's coming due? And you've been posting charts on this, what, $8 trillion, $9 trillion worth of debt has to be refinanced in the near future. Would you say that some of their main goals are they want a weaker dollar and then they want to refinance that debt?
Yes, and it's about half the debt is coming due in the next 3 years, and so that's 15-ish trillion. And it's a dangerous thing because if if they ease policy, they can borrow money on the front end, and that's like 1 year treasuries, 6 month treasuries. So if they cut rates, then they can borrow money on the front end, and supposedly stablecoins can support that as well. There's this legislation in Washington that really created a potential game changer there. But it's very dangerous for a large superpower to finance themselves on the front end of the yield curve. Janet Yellen was guilty of this in the previous administration, and right now the Trump team's guilty of it as well. We haven't termed out the debt, and it's a real big gamble. That's why they really need they need some type of a slowdown would actually help, because that would help you get lower long-term rates. If we don't get a slowdown and they just cut rates and the dollar weakens and then inflation comes back, then the yield curve will dramatically steepen. And all that means is 2-year yields will go down, 1-year yields will go down, and the longer term yields will go back up again. So it's very dangerous for a developed market, I mean, a large borrower to finance all your borrowing on the front end of the yield curve and not term it out.
And in the past, what you had big name investors like Warren Buffett in this type of economic scenario, if there was less inflation, they would have went in and bought longer duration treasuries as like a guaranteed yield, and they would have worried about a recession fears. They would have went and bought the longer duration treasuries. But I would argue that the demand is not really there for the longer duration treasuries. And then the other part of the equation on the supply demand imbalance, I would say for the U.S. Treasury market, is that the larger central banks, so the non-G7 central banks, they do not appear to be large net buyers of treasuries. They appear to be just dollar cost averaging gold tonnage each month for the last, 3 years since the Russia sanctions?
Yes, and they have a lot more bonds to sell. So the U.S. has much more competitors on the long end that are selling bonds. So the French yields are higher. The UK is in a worse situation. The UK has growth slowing less than 1%, but their inflation is double their target, really. So the rest of the world. The good news from the United States is the rest of the world's in a even worse fiscal and monetary position.
Yeah, I agree. I heard an interview with Kyle Bass in the last 6 weeks or so, and he was talking about the money supply growth in the US. I think the money supply growth in the US is up about 50%, I think he said, in 3 years. But then he pointed out that in other countries it was up even more. The money supply growth in other countries is up even more than in the US. So the average person, I don't think, understands that, yes, there's stagflation. If you're a small business owner here in the United States, you're getting killed, with the tariffs or higher input costs, but it's even worse in a lot of other countries, like you said.
Right. And this is the point of our book, How to Listen When Markets Speak. Everyone is essentially has the 2010 to 2020 playbook. A lot of people are long bonds, they're long growth stocks, and there's not a lot of ownership of commodities and hard assets. But once you move into that sustained inflation regime with higher global bond yields, then that creates an entire new portfolio construction mentality. You need to own more commodities, you need to own hard assets, companies, you need to own companies that will protect you from inflation. And if you look at, say, gold miners versus Nvidia, gold miners are crushing Nvidia. Copper miners are crushing the QQQs this year. So we're seeing some unusual things. Look at Hecla Mining today, HL. It was added to the S&P 600 small cap index. So what you're seeing is, and it was up 14%, Hecla Mining, HL Equity. And it's what's fascinating is nobody owns these stocks. There's such a small float. And so that when they tried to put Hecla into the S&P 600 small cap, uh, the fact that it was going into the index is so many shares to sales to buy relative to supply. The stock was up 14%. So it reminds me, these are the types of things you saw in the 80s during that stagflationary regime.
And the gold miners have a unique sweet spot, silver miners too, right now, because the energy prices, I don't see, at least for the next couple quarters, the threat of a huge energy price spike. So unless metals prices crash, you have a sweet spot of free cash flow. And I think out of any of the industries in the S&P 500, I think the gold miners have the most free cash flow growth out of any of the industries. So it's a real sweet spot for the gold miners right now.
Right. And it's been in our model portfolio at the bear trap support. We were getting a lot of hate mail a year ago because we were what we did was we took down our gold exposure and we added to silver, we added to gold miners. In other words, what happens in a bull market in commodities and metals is the mothership gold typically leads. And that happened 2020, 21, 22. Gold was the big winner, 23, 24. But then something shifted within the last 12 months. So we were long Agnico Eagle mines, we've been long Barrick, Newmont, and we're also long the GDX and the GDXJ in our model portfolio. And, that was pretty painful. But now we've seen this big move in recent weeks, in the last month and a half, where you can see the tourists are getting off the bus. Jason, you've seen the tourists, right? The heavyset guy with the Hawaiian shirt and the camera, right? All the tourists, a lot of hot money, what we call the tourists, are getting off the bus and they're coming in and they're buying companies that own assets in the ground because that's going to protect you from higher interest rates and inflation.
Well, hopefully, and we saw this in past cycles, the gold miners do not do dumb acquisitions because I think what Barrick Gold wasted billions of dollars, they wrote it off. There was a bunch of, I think they were buying copper mines at the top in 2011 and 12. They wrote off billions of dollars. The entire gold mining industry, Larry, I think by 2016 or 17, it had written off around 70 billion, some insane number. So hopefully they're a little bit smarter now with the mergers and acquisitions.
Well, Jason, that's a brilliant point because that's what creates new bull markets. Is like you said, that 2011 to 15 bear market. Well, the bear market really was climaxed in 2015, 16 for gold miners. And what happens is all the CFOs that made those horrible decisions got shot and fired. Same thing in the natural gas space. A lot of CFOs that didn't use capital discipline. They were undisciplined. They made bad acquisitions. And all of those bad decisions, what happens is that the new CFOs that come in and take over these companies are much more capital disciplined people because they've seen the pain. And coming out of that pain is what creates this new bull market where the companies have reduced debt, the cash flow is growing, and the balance sheets are stronger than ever. That's the case right now with the gold miners.
And that's actually how I found your work too in uranium 6 or 7 years ago before the pandemic. You were talking about a bottom in the uranium price, uranium miners. You were a little early on that. We obviously didn't see artificial intelligence and the data centers coming until the last couple of years. That's just kind of the cherry on top. But now that looks like we're in a long-term bull market as well as we see all these tech companies, whether it's Meta, Amazon, Google, all these large Microsoft, all these large tech companies are just scrambling to invest in next generation nuclear power or secure deals with some of these utility companies to expand an existing nuclear power plant.
Yes, and passive investing is really, I think once you get above 55, 56, 59% market share, passive versus active, and that's index funds, the passive investing becomes very, very evil because if you think of Microsoft, right? If you think of Nvidia and Microsoft, they're 15% of the S&P. Jack Bogle, the founder of the S&P 500 indexing, would be rolling over in his grave right now. The top two holdings of the S&P the last 30 years have averaged around 6, maybe 7 to 8%. In other words, the top two holdings, top two stocks should never be more than 8% of the S&P. The S&P is an abomination if the top two stocks are 15, 16% of the index. There's no diversification there. And so everyone's 401k, we talk about this in the book, is exposed to artificial intelligence, concentrated trades, all this CapEx. These guys are junkies in the valley. It's like really a testosterone eating contest. Everyone's trying to outspend the next guy, but there's no energy infrastructure to support the growth estimates. So this is going to be this is going to be a colossal failure of common sense 2.0. It's not going to be as bad as Lehman Brothers, but we're going to have a real crash in the next year and a half that comes out of this artificial intelligence. There's just not enough return on capital to fulfill the growth estimates. In other words, these companies are investing trillions of dollars. Companies that used to be cash cows, Jason, cash cows that produced cash, that were buying back stock, that had the cash on the balance sheet. Now they're capital intensive. They're grossly spending money like drunken sailors, and they're all trying to compete with the next guy, and there's no energy infrastructure to support these lofty assumptions.
Yeah, to add to your points there, I think the capital expenditure budget for like the Mag 7 was around $300 billion for this year for 2025, because a lot of these big tech companies are projecting between like 65 billion and like 80, 85 billion a year to be spent on artificial intelligence software, data centers, all these things. But they have not properly secured what all the natural gas pipelines, the power stations around there. So I'm more bullish, I think, longer term on building out the infrastructure, like you said, for what natural gas and uranium and nuclear power. I think those are probably smarter investments for this trend long term than picking out which artificial intelligence software is going to be the winner.
Right. And so what we've done, Jason, in our model portfolio, we're reducing our exposure to the gold miners here because we've had a nice run. So we've cut it down. And we were double exposed. So we were long Barrick and Newmont, but also long the GDX, which owns Barrick and Newmont. So we were overexposed. Today, we actually sold our Hecla position for the first time. We exited Hecla, HL equity, for the first time. We've been in the stock since 2020, but we're long the SIL and the SALJ. But we're taking down exposure to gold and silver miners, and we're adding to exposure in the natural gas space, natural gas pipelines, the FCG, Antero Resources, AR Equity, incredible story there, and also Range Resources, RRC.
In terms of contrarian for value investing for the commodities, I agree. I think oil and natural gas are really, really out of favor of the valuation. So I'm looking at like which companies are doing acquisitions. The larger and medium-sized oil companies are the ones they're cutting the fat right now. They're reducing drilling costs. They're if there's a merger and acquisition that just took place with ConocoPhillips, they're cutting staff. This is what happens in a bear market. You trim the waste, you go and buy assets for cheap, and then when the cycle turns, those are the companies that start to rally. You've called this before in uranium. We've seen this now in gold stocks. They have to go through the bear market first. They have to trim the waste first, and then when the rally does occur, that's when, as an investor, after a couple of years, that's when you start to make big gains.
Right. So look at Range Resources now. It's a speculative stock. It's not a large cap. It's 8 billion equity market cap, 8 billion, right? But, we think they're going to do $1 billion of free cash flow next year, right? So what's that? Like a 12 to 15% free cash flow yield. So your free cash flow is $1 billion, your $8 billion equity market cap. And think of the EBITDA. So their EBITDA, we think they're going to do $2 billion of EBITDA next year. So they're trading at 4 times EBITDA. They're buying back stock, right? So they're aggressively buying back stock. So the company is in there the last 2-3 years, aggressively buying back the stock, and they've reduced debt. Their debt was $3 billion in 2021, $3 billion of debt. Now their debt is approaching $1 billion, right? So you can just see these are much stronger balance sheets. They're taking that free cash flow, buying back equity, and you've got kind of that downside protection of that real capital discipline. But you're potentially, with some of these natural gas names, these are potentially 10 baggers in a world of artificial intelligence where you really have to ramp up that production to support electricity demand.
And I think what the average person doesn't understand, because they see all these tech companies spending all this capital, they're just starting to build out these data centers. So like Elon Musk, the XAI, the Colossus data centers in Tennessee, I mean, that's 100,000 GPUs that ramped up to 200,000, but the majority of the other big tech companies have just started construction on some of these next generation data centers. So these data centers aren't even built yet. I think there's a lot of the future there for the infrastructure and the energy plays for nuclear power and natural gas.
Right, and that's the downside for stocks like Nvidia. Nvidia probably drops 50% over the next year and a half, 2 years, because the estimates on data center construction are so rosy, and that's why everyone expects Nvidia's sales to keep growing. But there's not enough local. See, there's 2 ways to get out of this problem for energy bottlenecks, right? You can, in the case of it says SMR, so small modular reactors, like NuScale. You can put the small modular reactors, the SMRs, on site, but that's going to take a long time, at least 2-3 years. So we've got this huge expectation of growth in data centers, but you don't have enough natural gas and nuclear, wind, or solar on site to support that growth. But but even worse, the U.S. power grid is 50 years old in some places, 30 years old in others. So if you're going to rely on utilities to support data centers, then you're going to drive up the cost of electricity for middle class Americans, and that's a political nightmare. So either way, stocks like Nvidia probably go through a substantial crash over the next year and a half, even potentially the next 6 months.
Don't get me started on Congress here. Every time it seems like every couple of years, Larry, that an infrastructure bill gets passed, but then none of that infrastructure you're talking about actually gets fixed or upgraded or invested. It's been this way. I've lived right outside of Washington D.C. for 25 years. It's every couple of years that an infrastructure bill passes, and then the money is not spent wisely on the stuff that is needed.
Oh, yeah, and that's another real big inflation driver because the Biden team did a lot of spending. We were doing $2 to $3 trillion deficits, two to $3 trillion deficits for 4 years there, and so a lot of that infrastructure and CHIPS Act and things like that still hasn't gotten into the economy yet. That's one of the reasons why the economy's been so resilient. But the bottom line is it's all this like very, very, that's when we get back to Kyle Bass on the money supply. This is a lot of spending that's still oozing into the economy when the Fed has been trying to slow down inflation. They're up against this fiscal wave, this explosion of fiscal spending. The Fed can't kill inflation with fiscal expansion, expansion the way we've had it.
And it looks exactly like stagflation because we see the jobs report numbers. And anecdotally, Larry, I mean, like it didn't show up in the jobs reports initially, but for the last like 6 to 12 months, I mean, there's a lot of college graduates with really good resumes from elite universities. They're not getting job offers for full time now. So anecdotally, it looks like artificial intelligence software is going to be a net job destroyer. It's not going to create a lot of jobs, at least in the short term.
Right. And so in two ways, there's three potential problems, right? One is the tariff inflation that's probably just starting to appear. So we have an inflation problem. And then we have that artificial intelligence disruption of the labor force. But then we also have the artificial intelligence problem on the bottleneck side in terms of energy. And so there's all kinds of things that are out there that, hey, listen, the market always climbs the wall of worry, but there's so much concentration of wealth in those top 8 stocks that are so exposed to artificial intelligence and all these growth estimates that's where we get into passive investing. Once it gets up there near close to 60%, the money just flows in, right? It just flows in to the 401ks, and there's no discipline as to that's why, like, the idiocy of, like, right now, why should Nvidia trade at 28 times sales when, say, Google trades at 7 times, 6 times sales? Apple trades at maybe 8 times sales, and Microsoft trades at like 13 times sales. So you're talking about, and don't forget, these companies all over the last 30 years traded. Apple used to trade at 2 times sales, right? Google used to trade at 2 or 3 times sales. So Microsoft used to trade at 4 to 5 times sales. So all these companies are trading at a much higher valuation because of passive investing, and it gets back to all the money that's in indexes, your 401k, all that money in indexes. There's no discipline. There's no money. There's no portfolio manager. The money just goes in, no matter how crazy the valuation is on a price to sales basis.
And Mike Green has talked about this. This is the flaws with the market cap weighted index fund, that they're the victims of their own successes because the more people put into their retirement accounts, the more the market cap weighted index funds. It just goes into the same companies, like you said, and concentrates what into the Mag 7 at the top.
Right. And that's why I'm really worried that, so the boomers right now, the baby boomers are turning 80, the oldest ones. And they control 77 trillion of wealth. That's what we talk about in our book, How to Listen When Markets Speak. So the boomers are getting up there. The oldest boomers are 80. So that means the average boomers are like 72. And that's a lot of wealth that's concentrated in a few stocks. that's all basically a massive speculative bet on artificial intelligence. It's not a great way to invest.
And there's also record wealth disparity. What over the last 15 or 20 years, it's gotten even worse with the home prices and the stock market, the S&P 500, with the success of the general stock market indexes. The younger adults, a lot of them can't even get approved for a mortgage. So you have just record wealth disparity that, I mean, even if you have a pretty decent salary, you're not getting approval for a mortgage at the higher interest rates.
Right. And that's why when I was in Washington last week, we met with Treasury, and you could see the concern. The midterms are a year and 2 months away. So it's 14 months from now. And home affordability. So if that, a lot of these economists in Washington, they have an index. And so if you think of 100, that's where a home is like perfectly affordable. And so the last 20, 30 years, that index has been around, on average, around 85 to 90. So homes have been affordable. In other words, 100 is perfect, but really affordable is 85, and that's where we've been. But right now we're like up, that index is like up 125, 130. So homes are the least affordable ever. Like you said, that's creating a lot of wealth disparity for young people. So I really think the White House has a, this. What can you do about home prices, home affordability? You got to either lower the price of a home, and that would take a recession, so that's bad. You either can lower interest rates, right? That's another thing. Or you can increase incomes. So there's three ways to make homes more affordable: raise the income, lower the home price, or lower the interest rate. And out of those three levers, the easiest, slowest hanging fruit is trying to get interest rates down. And that's why I think the bond market's smelling this out, where they know the White House has to get rates down into the midterms to make homes more affordable.
Well, I would argue a fourth way. I think the problem is state and local. Let's use California with the Palisades fires. I mean, look at Gavin Newsom and all the bureaucrats there. They're making it almost impossible to rebuild all the homes in the Palisades. I mean, my state here in Virginia, Northern Virginia, it's pretty easy to get a home constructed and permitted and built. They can do it in a year, maybe a year and a half or less. In California, that would take many, many years the way things are going. They might not even rebuild that for many, many years in the Palisades. So I think it's a supply issue. It's just bureaucracy that's preventing what a supply of affordable housing coming online. I don't think it's I think it's more of a state and local issue with the governments there, and everyone, has their hand out. They want, permitting issues, environmental impact studies, and or bribes.
Right, right. Yeah, regulation and tax credits versus tax policy. You need a whole bunch of adjustments right there as
Well,
well.
yeah, I would blame the state and local level. Unfortunately, here, Northern Virginia here is way better at getting approval and constructing a house, like tearing down an old house and building a new house, versus California. California is a disaster.
Yeah, yeah.
So as we wrap up here, Larry, do you think then is DC going to allow an official recession? Are they going to allow deflation, or are they going to start pulling the levers in for more policies for a weaker dollar and other types of things? In your opinion?
Well, the easiest way out for them is try to inflate your way out by easing and creating, kind of a growth. Try to grow your way out of, through easing and creating. You grow your way out of this debt hole. So a $37 trillion debt hole, the only way out of that is default or suppress interest rates below the rate of inflation. That's it. There's 37 trillion. There's no way out. And so you either default like Argentina, or you try to, ease policy, weaken the dollar, and pay the debt back with cheaper dollars. But in that kind of world, that's where you want to be. In that, what we talk about in our book, How to Listen to Market Speak, is the old portfolio is 60-40 risk parity, 60% stock, 40% bonds. The point we make in the book is you really want to have that 35, 35, 30 portfolio: stocks, bonds, commodities. 35% stocks, 35% bonds, and 30% commodities. That's going to protect you in that kind of stagflationary world.
And the comments, to add to your points there, the comments from like non-G7 central banks and the BRIC central bankers, I mean, they sound like they've been reading Austrian school economics that basically like, oh, we have enough treasuries. Oh, we need to hedge with gold. Oh, we need to hedge with hard assets. So the central bankers are even acting like what you just said there, that they said, oh, we have enough treasuries. We need to hedge with more hard assets or gold.
Right. And that's where you get back to the word from our first book about Lehman Brothers. One of the most deadly words in all of finance is the H word, hubris. And hubris is Lehman management was really, that kind of arrogance, that foolish arrogance of hubris. And I think, in Washington, we've seen a lot of that, both Democrats and Republicans. Um, they've really have been played hardball on sanctions to a lot of our trading partners and a lot of our global potential bond buyers. Sanctions weapons been used aggressively. And, they really had a cockiness around the dollar. Like they thought, the dollar is supposedly the only game in town. But when you use that sanction weapon over and over and over again, over like 15 years, it's like a bully club over the head of all the many emerging market countries. Or when you use it aggressively against Russia with, oh, by the way, they meant well here. They're using it aggressively against Russia because of the crimes of the Ukraine war. But what does that do? What if you're India or if you're any other emerging market country and you see the United States confiscating wealth? You're going to think twice about buying treasuries. So the bottom line is that hubris in Washington has created less global bond buyers, and that's going to put even more pressure on the Fed to buy our bonds.
Exactly. That I think that's the main macro theme the last 3 years post Russia sanctions is basically like Yosemite Sam from Looney Tunes, where he accidentally shoots himself in the foot because they'd go on TV, like you said, the people, whatever administration or Congress, and say, "Oh, we're going to get Russia. We're going to increase sanctions." It's backfired spectacularly to the point where a lot of the non-G7 central bankers and the BRICS countries have just said if they're going to confiscate or freeze what 300 billion and the interest payments of Russian assets, if we piss off DC, they're going to try the same stuff with us with these sanctions or confiscating our assets. We're going to start hedging with gold. And you could see that in what the dollar cost averaging of the gold tonnage post Russia sanctions in 2022.
Yes, and gold, Bitcoin, platinum, and palladium, the entire market cap of all the platinum and palladium is only $300 billion, right? It's a fraction of Bitcoin, right? And so that's why precious metals, or what we call platinum group metals, have such a valuable part of your portfolio construction, because there's just not a lot of platinum, there's not a lot of palladium, there's not a lot of silver out there. We're in a silver deficit of production wise.
So, true or false, as we wrap things up here, do you think it's an eventuality, a question of when and not if we get to 4,000 or 5,000 gold? Because it seems that the policy, whether it's Trump or a Democrat in the White House, whoever controls Congress, they don't really seem to want to cut spending. Just for Trump to pass the tax cuts, he had to do a bunch of trades. The budget deficit's still growing. It doesn't seem like there's actually any real spending cuts, even though small business owners may have gotten some tax cuts. So, do you think then that it's an eventuality that we're going to see weaker dollar, higher gold prices?
Yes, but in our book, what we talked about is, gold was a little bit less than 2,000 when we wrote the book, and we were saying, okay, we're going to go to 3,000. And so now here we are at 3,600. 4,000 is just, a chip shot away, especially after a long consolidation period. I looked at it this morning, Jason. Do you know that we essentially stayed at the same price for almost 4 years? In other words, gold was gold from 2020 to 2024 was essentially in that range where we couldn't really take out the high. Now that we've taken out the high after that long period of consolidation, that's where it's you can really accelerate once, because nobody owns gold at a loss right now. There's not one person in the world today that's sitting on a loss on gold, and so that's what gives you that extra kind of firepower to the upside.
I actually made an economic cartoon about that with ChatGPT. I don't know if you saw it. I put it on X. It's like the dam is broke. It really feels over the last couple months like the dam, all the cracks that were in the dam is finally broken, and that I think it's a question of when we see gold at 4,000 or maybe even 5,000 over the next couple of years.
Well, Goldman says if just 1% of global bond buyers, so think of like everyone that owns long duration, long term, 30-year UK bonds, and think of everyone that owns long duration French bonds, and think of everyone that owns long duration Japan bonds. Those investors have lost money every year since 2022. So it's like over $1 trillion of bonds that are in the hole losing money for not just 1 year, not just 2 years, but 3 years. And this is, remember, bonds for like 20 years made money almost every year as interest rates kept going down and down and down and down and lower and lower and lower. People don't understand what's happening. Literally thousands and thousands of high net worth investors are sitting in long duration global sovereign bonds, and they're losing money. Look at Apple. Apple issued a bond in 2021-ish. It was a $2 billion bond, 2.55% coupon due in 2060. This is issued by Apple, Jason. Okay, a $2 billion bond issue issued at par or 100, and it's a 2.55% coupon due in 2060. That bond just traded in the last month down at 54 cents on the dollar. That's the power of what happens with interest rates go up, bond prices go down, and bonds that were issued in 2020, 21, 22 by governments around the world or by Apple, whatever you want to say. If it's a French bond and you had a 1 or 2% coupon, or if it's a Japanese bond, it's a 1 or 2% coupon. Those bonds are sitting around on someone's balance sheet at 60 cents, 55 cents on the dollar. I mean, that's a tremendous amount of losses. And so what happens is, as those losses pile up over years, over net 3 years now, since 2022, that drives more and more and more and more capital into hard assets.
Yeah, I agree. It looks like the government bonds, whether it's the US or Japan, Europe, a lot of other countries, they look like the most radioactive asset class right now. I know there's a lot of hedge fund managers that are starting to look at this as a dead cat bounce or some type of like a short squeeze rally trade. I wouldn't want to pick up 20 or 30% there. I wouldn't want to. I would go look at oil and natural gas companies. I mean, there's a lot of other contrarian value investments in other industries I'd rather make than government bonds right now.
Right. Yeah. And you got great dividends in some of these oil and gas pipelines that are going to be needed to move the gas around. You're going to need new pipelines, new infrastructure to move the oil and gas around to support those data centers. And the dividends are remarkable. So, I mean, absolutely beautiful dividend streams. Look at energy transfer, ET equity. We put it in our model portfolio back in 2020, 21. Beautiful dividend and growth over the last several years. Because remember, these are just like toll takers. Everybody's taking their car through a toll taker, right? And on a kind of a highway that takes that toll. Same thing with oil and gas pipelines.
And there's some growth there too, as long as they build out the pipelines, the oil or natural gas pipelines from like the Permian Basin or another natural gas basin to a liquefied natural gas export facility or a data center. So I think there's some growth there too.
Yeah, energy transfer right now, just pull it up. Energy transfer. So picture this in your mind. The stock is gone from, okay, the stock is going, wow, it actually looks like a great buy down here. But the stock in 2021 was $6. And it traded recently at $20, but now it's like 17. So it's gone from $6 to say 17 now, right? And your dividend is 7.7%. So it's gone from $6 to $17, energy transfer, ET equity. And it's paid this juicy, beautiful dividend the whole way. And it's gone from $6 to $17, and it still pays 7.7%. That is a very attractive investment relative to bonds. Because remember, a bond is issued at 100 or 1,000, whatever you want to call the face, and it matures at 100, right? So, and it pays that coupon along the way. Energy transfer, you buy it at 6, it's gone to 17, and it paid you a very healthy 10% dividend the whole way. Now the dividend's down to about 7%, 7.7.
Well, also, Larry, the oil and natural gas company isn't trying to inflate away the debt or lie about the money supply or do debt monetization or yield curve control, or their central bank isn't refusing a real full independent audit to lie about like the debt monetization or other things like that. So the oil and natural gas company is going to have to run a cleaner ship more efficiently than a government will with the money supply.
Right, right. Well, I got to get going because the family, it's getting late here. But I really appreciate you for reaching out, and we'll do it again soon.
Yeah, this was a great conversation. Thank you so much. And when you're down here in Northern Virginia or DC, give me a holler and we can have lunch or dinner or something.
Okay. Thank you, Jason.